took out your Sun Alliance pension, they made two guarantees to you. They guaranteed that at your retirement date there would be a guaranteed minimum fund value. That figure is expressed by the guaranteed basic sum plus all the bonuses that they've added up until this point and may continue to add at your retirement date. The second guarantee is that they promised that they would convert whatever value of your pension is, whether it's the guaranteed value or higher, they would convert that fund into an income, into a pension income at a guaranteed rate. At the time of offering those guarantees, they thought they were making cautious and prudent assumptions. Over a period of time, with increasing longevity and with interest rates coming down, they're starting to look extremely generous. All of which is bad news for the Phoenix Life Group, the company that now owns that book of business, and good news for you. But we believe it's about to get even better for some of you. What Phoenix do is they look at the guaranteed benefits that they're promising you, and they apportion a value to that. They then compare that to the actual value of the money that you put into the pension. So if you like, that's the assets and these are the liabilities. And when they look at what your pension's actually worth and compare it to the value that they guaranteed you, they can see there's a big shortfall. So in order for the fund to remain solvent, what they need to do is to use shareholder funds to bolster up that side of the balance sheet. Now that's an expensive exercise for the shareholders, and that's money that's going to stay tied up in the fund for the next 30 odd years or so. As a result, the shareholders don't want it to get any worse. So they don't want the value of your assets to fall too much further. So what they do is they invest the fund very cautiously. They own government gilts, corporate bonds, and they tend not to own shares of companies or commercial property. And what that means is that the growth prospect of your assets are really quite low. In reality, therefore, you're likely to be retiring on a value that is currently represented by the guaranteed value and no more. And that's where this offer comes in. Rather than tie up that shareholder capital for a long period of time, they're saying, I'll tell you what, why don't we give that to you now in return for you giving up your rights to the guaranteed pension rate. They've run some projections that say that you are likely, highly likely, under their assumptions, to retire on a pension that is higher than the guaranteed value if you do that. They're going to change the investment strategy so that the prospects of an investment return being much higher exist. But are those assumptions right for your personal circumstances? Our second video takes a quick look at what those assumptions are. You can see whether your circumstances are likely to differ from those assumptions. And the video will also explain why we think it's important that you seek independent financial advice in this decision.
Er